Do you know what's common between companies that suddenly go bankrupt? It's not poor profits or falling revenues. One of the key red flags is actually whether a company can convert its profit into real, usable cash. A real-world example is Opto Circuits Limited, a company that specialized in medical devices and healthcare technology, once trading at 662 rupees, now is in insolvency. On the surface, its P&L told a story of growth. But behind those glossy profit numbers, the real cash flow was nowhere to be found. Year after year, Opto reported handsome net profits, yet its operating cash flow lagged badly. Receivables piled up, inventories swelled, and each quarter the gap widened. In fact, for 10 years until FY13, Opto Circuits had accumulated a net profit of 1,272.6 crore rupees. Yet its operating cash flow stood at 206 crore rupees, equating to just 16.19% of the net profit. To plug the holes, the company turned to desperate measures, issuing millions of new equity shares and borrowing heavily, all without generating the cash to fully fund operations organically. Even its cash conversion cycle worsened every year. Despite repeated debt restructurings, Opto simply couldn't turn its profits into spendable rupees. Eventually, the firm entered the corporate insolvency resolution in June 2023. Without real cash in hand, even solid earnings on paper proved worthless. But why does this matter? Stories like these are everywhere in the Indian stock market. Companies show big accounting profits, but when the bills come due, there's no actual cash to pay suppliers, service debt, or even fuel growth. Some of the most painful collapses in corporate India, think of high-profile real estate failures like Unitech or the Satyam scandal, were preceded not just by falling profits, but shrinking flow of real hard cash. Investors who only tracked net profit were blindsided. Yet, those who watched the operating cash flow saw danger well before the disaster struck. This is exactly where Warren Buffett's wisdom comes in. Buffett has long insisted that operating cash flow is the real test of business health, famously saying, "Cash is to a business what oxygen is to an individual." Never thought about when it is present, the only thing in mind when it is absent. For Buffett, revenue is vanity, profit is sanity, and cash is king. Welcome to Bottom Line by Grow. Today we'll explore why operating cash flow is key to understanding a company's true health and how relying solely on net profit or EBITDA can be misleading, while also discussing OCS limitations for better investment insight. Let's start with the basics. Most investors are familiar with net profit, which is the bottom line figure on the profit and loss statement after deducting all the expenses, interest, taxes from revenues. But net profit is an accounting concept and based on an accrual system. This means that revenues are recorded when earned, not necessarily when cash is received, and expenses are recognized when incurred, even if the actual payment happens later. This approach, while essential for tracking economic activity over a period, can sometimes create a gap between what looks like profit on paper and the reality of what cash is actually available in the business. Thus, net profit can include numerous non-cash items and is subject to managerial estimates and policies. Contrast this with operating cash flow, which measures the real cash generated from a company's core business activities in a given period. Operating cash flow doesn't care about invoices yet to be paid or future promises of revenue. Instead, it shines a spotlight on the money actually flowing in and out of the business, stripping away the effects of accruals, credit sales, or unpaid bills. Simply put, cash flow from operation answers the question, after all the sales and expenses, how much cash did the business really produce from its normal operations? This is crucial because, as the saying goes, earnings are an estimate, cash is real. And the way it's calculated? Since adjustments are made because net profit doesn't reflect the actual cash flow, non-cash items like depreciation and changes in working capital such as receivables or payables are adjusted to show the true cash generated or used by the business. Other factors like taxes and interest are also considered to accurately reflect the real cash movement. This method helps convert profit into actual cash flow, giving a clearer picture of how cash moves through the business. But why exactly is operating cash flow considered more reliable? First, as we already covered, operating cash flow slices through the accrual fog. Secondly, OCF is harder to manipulate. Now, net profit is vulnerable to various accounting adjustments and even manipulation, which can take various forms. Aggressive revenue recognition. For example, booking sales before delivery, known as channel stuffing, can inflate earnings. Ahead of its IPO, Mamaearth, Honasa, pushed excess stock into its offline distribution network, leaving its dealers with 90 days worth of inventory, well above the usual 30-day credit terms. Distributors struggle to clear the surplus without heavy discounts or returns, a clear case of channel stuffing. A follow-up report revealed that Mamaearth extended credit periods to 45 days and offered deep discounts to offload the excess, artificially boosting the quarterly revenues at the cost of future sales. Capitalizing expenses. Capitalizing expenses shifts costs from the P&L to the balance sheet as assets, boosting net profit by amortizing them later. While sometimes legitimate, like development costs, companies may inflate profits by capitalizing operating expenses like repairs, advertising, or R&D. This increases profits, but the cash outflows still occur and show under-investing activities as capex. As a result, OCF often looks unusually high compared to operating profit. However, some of these companies classify these cash flows as investing, keeping OCF high. Dish TV India Limited offers a textbook case. Instead of expensing huge subscriber onboarding and license fees, it capitalizes them as customer and distributor relationships, amortizing these costs over years. The cash still leaves the business, shown under investing activities, but by not charging it through operating expenses, OCF looks artificially strong compared to profit. One-time gains. Selling assets or booking one-off gains can raise profits artificially, but OCF exposes this by excluding such non-recurring sources. In Q1 FY26, Reliance's net profit saw a remarkable 78% increase, reaching 26,994 crore rupees. Although this strong performance was partly driven by a one-time gain of 8,924 crore rupees from the sale of its Asian Paints stake, core earnings still showed growth, with the gain serving as an additional boost. Dealing expenses. Under-provisioning for known expenses like warranties or bad debts can temporarily boost profit. While OCF might not spotlight this immediately, related working capital trends such as rising receivables or payables will eventually flag it. Infrastructure Leasing and Financial Services, or IL&FS, was operating a loan book of roughly 91,000 crore rupees by FY18. Yet, the RBI found it hadn't declared non-performing assets at all for the 4 years leading up to that date. By FY18, NPAs were pegged at 70% of its advances, around 63,700 crores, yet IL&FS made virtually no provisions against these sourced loans until defaults forced the issue mid-2018. That delayed provisioning masked the company's true stress and helped inflate reported profits until the eventual catch-up wiped out tens of thousands of crores in a single blow. Thus, while the management can temporarily inflate earnings to make profits appear healthy despite underlying business weakness, operating cash flow is much harder to manipulate. Reviewing both metrics, and especially their relationship, provides a robust filler for assessing earnings quality. Third, OCF reveals quality of earnings. Ideally, over the long run, a company's cumulative OCF should equal or exceed its cumulative net profit, since all legitimate accounting profits should eventually turn into cash when customers pay up. If net profit is significantly higher than OCF in a period, it could indicate that profits are tied up in uncollected revenues or unsold stock. Conversely, OCF can sometimes exceed net profit. This can happen if a company has a large non-cash charge like depreciation, impairments, or favorable working capital movements. For instance, Hindustan Unilever, an FMCG giant, typically converts nearly all its profit into cash year after year. In some years, its OCF even exceeds net profit because it collects cash from distributors quickly and often has negative working capital. As such, over the past 10 years, the company reported a cumulative net profit of 74,671 crore rupees, while its operating cash flow totaled 84,395 crores. 4. OCF is comprehensive. It reflects the true business reality. While metrics such as EBITDA are useful, they can be misleading. EBITDA is an income statement metric that ignores working capital changes and does not reflect important recurring operational cash requirements. A company could post a high EBITDA while its OCF is weak due to a build-up in receivables or inventory, reflecting deeper operational challenges. OCF incorporates these realities by factoring in the impact of working capital movements and non-cash expenses, showing what the business really earned in cash in a given period. Operating cash flow behaves very differently across industries, shaped by sector-specific business models, sales cycles, and working capital requirements. Not all industries are created equal when it comes to converting profits into actual cash. First, real estate and infrastructure. Construction and development are cash intensive. These companies often post healthy profits by recognizing revenue on long-term projects, but actual cash inflows lag until customer payments arrive. For example, developers using the percentage of completion method book revenue early, while the cash only comes later, creating a gap between the net profit and the operating cash flow. Take Oberoi Realty. Over the decade through FY23, reported roughly 7,100 crore rupees in cumulative net profit, but saw about 1,780 crore rupees cumulative operating cash outflow, highlighting how cash lags profit in long gestation business. In FY23 alone, PAT surged to 1,905 crore rupees, while OCF plunged to 2,383 crore rupees as 3,507 crores of inventory built up and receivables stretched under percentage of completion accounting. Once projects were delivered and collections caught up, OCF rebounded to 2,816 crore rupees in FY24, realigning cash flow with earnings. Among EPC contractors, road builders, power plant developers, and the like, the story is similar but on an even larger scale. A striking example is PNC Infratech. It posted a net profit of 815 crores, but its OCF was almost nil due to delayed client payments and rising working capital strain. While OCF generally kept pace with profits through FY21, by FY22 the gap widened. Despite profits rising to 815 crores in FY25, OCF dropped to 56 crore rupees as receivables swelled and inventory built up, with the collection cycle nearly doubling from 37.5 to 76 days. L&T, by contrast, leverages scale and diversifies its order books to keep its OCF roughly in step with net profit over the long term, though even it had its quarters where working capital spikes squeezed cash. The lesson here is simple. In infrastructure and real estate, OCF often trails profit during growth, but if the gap continues, it's a warning sign. For NBFCs like Aavas Financiers, growing loan books often result in negative OCF, which is expected as cash is tied up in loans. This doesn't signal poor health. One must see if the negative OCF is funded by debt or equity raising. For lenders, other metrics like NIMs and asset quality ratios give clearer insights, but OCF still reflects liquidity strategy and can signal shifts or stress in the loan book. Third, FMCG and retail. By contrast, consumer-facing staples are true cash generation machines. FMCG companies like HUL, Dabur, Nestle are typically cash-rich because of their business models. These companies sell products quickly, often for cash or short credit terms, and manage inventory efficiently. FMCGs generally have negative working capital cycles, meaning they collect cash from customers faster than they pay suppliers. Technology and new economy startups. Here we see a tale of two subsectors. The large IT service firms, TCS, Wipro, Infosys, operate almost like FMCG when it comes to cash. They invoice clients monthly and collect in a few weeks, convert roughly 90 to 100% of profit into OCF, and reinvest only modestly in capex. By benchmarking a company's cash conversion against these sector norms, an investor gains a powerful lens into operational reality. In cash-rich industries, any surprise shortfall in OCF demands investigation. In cash-hungry sectors, persistent gaps between profit and cash suggest funding stress or aggressive accounting. Understanding these sectoral dynamics is essential to separating businesses that merely look profitable on paper from those actually generating and sustaining the cash that creates long-term value. Understanding operating cash flow conceptually and spotting discrepancies is one thing. But how do investors incorporate OCF analysis into their decision-making? Even more telling is when profits climb but OCF stalls or falls, suggesting accounting tweaks or overly optimistic revenue forecasts. Watch these working capital lines. Ballooning receivables or stock that isn't selling will erode cash flow. Whenever the gap between profit and operating cash widens, it is a red flag worth investigating before problems spiral. Moreover, companies relying on rising debt to fund their operations instead of generating cash from operations are at risk of financial distress. If a company has consistently rising net profit but increasing its debt, it is crucial to examine the OCF. For instance, Jet Airways reported profits in some years, but its poor OCF due to high operational costs and low yield eventually led to a massive debt buildup. As such, investors can use OCF analysis to see if a company is borrowing excessively to sustain operations. If OCF is weak, it is a sign that the company may be borrowing or raising equity to cover its cash shortfall, in which, if OCF is weak, it's a sign that the company may be borrowing or raising equity to cover its cash shortfall, which is unsustainable in the long term. It's clear that operating cash flow is a powerful health metric, but it can be imperfect and still be distorted or misinterpreted. Cash flows are indeed harder to fudge than accrual profits. Managers can't simply book phantom sales and write off expenses that never happen. But firms can still influence OCF through their treatment of working capital. For example, a company might stretch out payables or pull in customer advances to inflate short-term cash from operations, tactics that can only postpone the cash drain, not eliminate it. Also, at times, isolated surge in OCF can be tempting, but it often reflects one-off working capital swings rather than sustainable earnings power. Moreover, investors place heavy emphasis on operating cash flow, so companies often go to great lengths to present it favorably, at times even slipping non-operating inflows into CFO to inflate the number. Albert David Limited, a Kolkata-based pharmaceutical company, sold its Actable brand to Zydus Healthcare in FY16 for 55 crore rupees, booking a net of tax exceptional gain of 40.8 crores. Now, the amount spent by the company to create brands is considered capital investment or intangible assets and is considered as cash outflow under investing section. Similarly, whenever companies sell their brands and related assets, then investors assume that the cash received by them will be shown as cash flow under investing section. However, in FY16, Albert David Limited has shown the proceeds of 53 crores received from the sale of the brand Actable to Zydus Healthcare in the cash flow from operations. While OCF is a critical barometer of real cash generation, it can be distorted by aggressive working capital moves and one-off items. To avoid the pitfalls of cash flow tunnel vision, investors must marry OCF analysis with free cash flow, profitability ratios, working capital metrics, capital efficiency measures, and macro sector context. Only then does true cash really tell the whole truth. What do you think? Share your thoughts in the comments below.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.